On February 28, 2026, the global energy market was turned upside down. In just a few days, Brent crude surged 72% to $115 a barrel. And while the world braces for an inflation shock, one country is quietly watching its economic death spiral vanish overnight. Just 2 weeks before the US and Israeli strikes on Iran began, Russia was hemorrhaging cash. Oil revenues were down 47%, corporate bankruptcies were surging, and its war in Ukraine was costing over $500 million a day. But another war 1,600 miles away from Ukraine has transformed Vladimir Putin from a desperate outcast into the ultimate geopolitical beneficiary. And today we crack open the data behind Russia's miraculous financial rescue, reveal the hidden constraints quietly eroding this windfall, and expose why the dismantling of Western sanctions might be the most dangerous secondary effect of the Middle East crisis. My name is Nick, and you're watching Coin Bureau Finance. To appreciate the sheer magnitude of this sudden reversal, we first have to look at how close the Russian economy was to the brink of collapse. The mainstream media was largely focused on the battlefield in Ukraine, but the real crisis for Moscow was happening on a spreadsheet. For decades, energy exports were the lifeblood of the Russian economy. Back in 2021, oil and gas revenues accounted for roughly 45% of the entire federal budget. But by the end of 2025, that number had plummeted to just 22.7%. The structural damage from Western sanctions, a global oil surplus, and the G7 price cap had finally caught up to the Kremlin. In January and February of 2026, the situation went from bad to critical. According to Russia's own finance ministry, oil and gas revenues for those 2 months combined totaled just 826 billion rubles, or around $10.4 billion. And that was a brutal 47% collapse compared to the exact same period a year ago. And the federal budget deficit blew out to 1.7 trillion rubles, which is about $21.5 billion, in January alone, eating up nearly half of the government's target for the entire year in just 31 days. Now, I know what you're thinking. Russia has been selling record amounts of crude to India and China to bypass those Western sanctions, so how could their revenues be collapsing so violently? And the answer lies in a toxic mixture of steep price discounts and a bizarre currency trap known as the ruble paradox. In late February 2026, Russia's flagship Urals crude was trading at roughly $40 a barrel, and that was a massive $31 discount below the global benchmark dated Brent. But here is the real problem for Moscow. The 2026 Russian federal budget was built on the assumption that Urals would average about $59 a barrel, with an exchange rate of 92.2 rubles to the dollar. But the ruble was actually trading much stronger, hovering around 77.8 to the dollar. Now, for those who don't know, a strong currency is usually a sign of economic health. But for a commodity exporter like Russia, a strong ruble is a fiscal nightmare. And that's because oil is sold in dollars. But the Russian government pays its soldiers, pensioners, and domestic contractors in rubles. And when the ruble is strong, every petrodollar they bring in converts to fewer rubles to spend at home. At an exchange rate of 77.8, Russia mathematically needed Urals crude to trade at around $70 a barrel just to meet its own budget assumptions. Instead, they were getting $40 a barrel. And the result was a corporate bankruptcy crisis that was tearing through the Russian private sector. By the end of 2025, the number of unprofitable medium and large enterprises in Russia had surged by 16%, with total losses hitting $97.3 billion. With the central bank's interest rate at a crushing 21%, and nearly a quarter of all corporate revenue in Russia was generated by companies in a financially vulnerable position. Samolet, Russia's largest property developer, was effectively begging for state bailouts just to survive. Around 20% of Russian property developers found themselves on the brink of bankruptcy due to falling sales and high interest rates. And the transport sector was also collapsing, with high borrowing costs threatening to push 30% of freight carriers into insolvency. The entire Russian coal industry in the Kemerov region saw their income tax revenues collapse by nearly 60%. Russian economist Igor Lipsitz stated bluntly that the civilian sector was dying, shrinking, and declining. And the National Wealth Fund, Russia's ultimate rainy day piggy bank, was on track to be completely depleted by the end of the year. The government was eating into more than half of its financial buffer just to bridge the widening gap between revenues and military spending. The system was bending under the weight of its own war machine, and the maths simply wasn't adding up. And then the Middle East exploded. On February 28th, Operation Epic Fury commenced, and within days, the Islamic Revolutionary Guard Corps effectively closed the Strait of Hormuz to Western shipping. And this wasn't just a regional skirmish. The Strait of Hormuz is the central artery of the global industrial engine. More than 14 million barrels of crude oil pass through that 24-mile-wide choke point every single day. And that represents roughly 20% of the world's entire seaborne oil supply. And that closure wasn't enforced by a massive naval blockade, but by an insurance-driven shutdown. War risk premiums for vessels transiting the Gulf surged, and major shipping companies simply refused to send their tankers into a live combat zone. When that massive chunk of supply was paralyzed, the global oil market violently repriced. Brent crude went from $67.41 on February 8th to a peak of $115.89 on March 8th. That is a 71.9% move in just 28 calendar days. And as global prices skyrocketed, Russia-Urals crude was dragged up right along with it. In a matter of days, the price of Urals more than doubled, briefly trading above $91 a barrel and perfectly bailing out the Kremlin's bleeding balance sheet. But it wasn't just the price that shifted in Russia's favor. The closure of the Strait of Hormuz completely rewired global supply chains. Asian economies, particularly India and China, suddenly found themselves entirely cut off from their primary Gulf suppliers. Kuwait, Iraq, and Qatar essentially had no alternative routes to export their crude. So, where do the world's largest energy importers turn when 20% of global supply vanishes overnight? They turn to the one major producer whose seaborne exports don't rely on the Strait of Hormuz. And that's right, it's Russia. Since 2022, Western sanctions had systematically forced Moscow to build a massive shadow fleet and redirect its exports through the Baltic and the Black Seas. What was designed as a punishment had inadvertently built the exact logistical alternative the market desperately needed in 2026. And the United States government was forced to acknowledge that reality. On March 5th, the U.S. Treasury Department issued a 30-day sanctions waiver. And this allowed Indian refiners to purchase millions of barrels of Russian-sanctioned oil that was already loaded on vessels at sea. The Trump administration found itself in an impossible position. They had to temporarily dismantle their own sanctions architecture just to stop global energy prices from causing a worldwide recession. Treasury Secretary Scott Bessent issued the waiver specifically for oil already stranded at sea, calling it a, quote, temporary relief valve. But congressional Democrats fiercely pushed back, calling the waiver dangerous, self-defeating, and an inexplicable act of material benefit to the enemy. Despite the political backlash, the economic reality forced Washington's hand. Within days, at least 3 massive tankers carrying 1.4 million barrels of Russian oil abruptly changed course from East Asia and headed straight for Indian ports. Kepler analysts reported that India likely bought up to 8 million barrels of Russian oil over a single weekend, returning to pre-sanctions levels of purchasing. But there is another hidden layer to this geopolitical windfall, and it involves Venezuela. You see, different oil refineries are built to process very specific types of crude. India has invested billions of dollars building refineries with high Nelson complexity indices, meaning they are specifically designed to process heavy, sour, and sludgy crude oil. The United States, however, produces light sweet crude, which is great for making gasoline, but largely useless for these specific Indian refineries without expensive modifications. So, Historically, India relied on heavy crude from Venezuela, Iran, and Russia. But in January 2026, US forces captured Venezuelan ruler Nicolas Maduro and effectively seized control of Venezuela's oil exports. And this removed roughly 300,000 barrels a day of crude from the Asian markets, and a month later, the Iran war cut off Iranian heavy crude. By a stroke of pure political luck, or perhaps calculated design, Russia was suddenly the last sanctioned heavy crude supplier left standing. They had a monopoly on the exact type of oil that the world's fastest-growing economies desperately needed, creating a massive structural advantage that goes far beyond a temporary price spike. Now, when the global supply chains snap and energy markets reprice by 70% in a month, the financial fallout doesn't stay confined to the Middle East. It hits your cost of living, your investments, and your purchasing power. And speaking of surviving macroeconomic chaos, if you want to navigate these unprecedented market shocks and come out in one piece, you should check out our free weekly newsletter. Every week we break down the complex geopolitical data the mainstream media just ignores. We connect the dots between global conflicts, central bank politics, and the actual assets in your portfolio. You can sign up right now by checking out the link in the description or by scanning this QR code on your screen. It's completely free, and it is the best way to ensure you never get caught off guard when the macro environment shifts. Okay, back to the video. At first glance, you might think that Vladimir Putin has just secured a permanent blank check to fund this war machine indefinitely. With Ural's crude surging past $70 a barrel, the Russian budget seems completely repaired. But there's a catch, and it's one that the sensationalist headlines are completely missing. Russia's financial gains are actually significantly smaller than they appear, and they are being quietly eroded from 5 different directions. First, let's look at the famous sanctions discount. When Brent crude skyrocketed to $115 a barrel, you would assume that desperate buyers would be willing to pay a premium for reliable Russian oil. Well, they weren't. According to Argus media data, just before the war began, the discount on Ural's crude compared to the Brent benchmark was sitting at $30.62 a barrel. By March 3rd, right in the middle of the global panic, the discount actually widened to $30.90 a barrel. In plain English, Russia is earning more money simply because the entire global ocean of oil rose in price, not because anyone is offering them better terms. Buyers still demand massive punitive discounts just to take on the legal and insurance risks of touching Russian crude. And second, we have the infrastructure bottleneck. For the past year, Ukrainian drones have been relentlessly pounding Russian energy facilities. According to Bloomberg calculations, Ukraine carried out 81 attacks on Russian oil refineries in 2025 alone. And these strikes have knocked out an estimated 500,000 barrels a day of crude processing capacity. Russia's Volgograd refinery, one of the country's largest, was forced to halt a major distillation unit in February 2026 after a drone strike triggered a massive fire. Because their refineries are damaged, Russia is forced to export more raw, unrefined crude, which sells for significantly less than premium refined products like diesel. And third, there is the hard physical ceiling on what Russia can actually produce. Even with prices surging, Russia cannot simply turn on the taps and flood the market. In January 2026, Russia actually produced 328,000 barrels per day less than their allowed OPEC plus quota. They are underperforming because their primary Western Siberian oil fields are aging and experiencing natural depletion. And without the technology and expertise of departed Western oil field services companies like Halliburton and Schlumberger, Russia simply cannot exploit new, complex shale reserves. They are physically maxed out. And fourth, the Russian shadow fleet is facing an existential crisis. Russia relies on a fleet of over 1,300 aging, underinsured tankers to move 65% of its seaborne oil. And the average age of these vessels is 18.1 years old, past the threshold where technical failures increase sharply. And Western interdictions have escalated dramatically. The EU recently sanctioned dozens of these vessels, which immediately strips them of their protection and indemnity insurance. And without insurance, these ships cannot legally dock at most global ports, and the cleanup costs for potential oil spills are creating international outrage. The logistical friction is eating massive holes in Russia's profit margins, forcing them to reflag vessels and hide their movements. And finally, there is the dynamic price cap. The G7 didn't just leave their oil price cap at a static $60 a barrel. In late 2025, the EU shifted to a dynamic mechanism that automatically sets the cap at 15% below the average market price of Ural's crude over the previous 6 months. And this acts as a mechanical ratchet. As the war in Iran drives prices higher, the rolling average increases, and the price cap chases Russia's gains right up the chart. The Bank of Finland noted that this mechanism forces all trading parties to be constantly vigilant, giving buyers even greater bargaining power to demand discounts. The windfall is real, but it is leaking through a dozen different structural holes. But the third scenario, and perhaps the most terrifying aspect of this entire geopolitical chess game, has nothing to do with oil. It has to do with natural gas. And this brings us to Europe's ultimate nightmare. And by the way, we actually recently did a video on exactly this topic, which you can watch right over here. But the point of the matter is that the panic in Europe is palpable. On March 9th, Hungarian Prime Minister Viktor Orban formally demanded that the European Commission immediately suspend all sanctions against the Russian energy sector. Norway's energy minister warned that the debate over banning Russian gas would inevitably be reopened. And the head of the International Energy Agency, Fatih Birol, had to publicly plead with the European leaders, warning that returning to Russian gas would be, quote, economically and politically wrong. He called Europe's past over-reliance on Russian energy one of its historical mistakes. But here is the multi-trillion-dollar twist. Vladimir Putin is no longer the desperate seller. He has completely inverted the power dynamic. On March 9th, Putin formally tasked the Russian government with assessing the feasibility of terminating energy supplies to the European market entirely. He explicitly threatened to redirect Russian gas to more promising markets in Asia, effectively telling Europe, "You didn't fire me, I quit." He's using the chaos of the Middle East to break the back of the European sanctions regime. And the situation could get exponentially worse. Qatar's energy minister Syed Al-Kaabi has issued a chilling warning. He stated that if the conflict persists, all Gulf energy producers will be forced to shut down exports within weeks. In that doomsday scenario, Goldman Sachs projects that crude oil could surge past $147 a barrel, and gas prices could climb to an unprecedented $40 per million British thermal units. If oil hits $150, the global economy goes into an immediate, devastating recession. Factories will be shut down, supply chains will freeze, and inflation will become a permanent embedded nightmare. And this brings us to the ultimate strategic paradox sitting on the desk of the US president. Donald Trump is currently fighting a multi-billion-dollar war against Iran. But because that war has caused energy prices to skyrocket, he is inadvertently funding Iran's closest military ally, Russia. The US Treasury is issuing waivers to let India buy Russian oil, effectively unlocking billions of dollars for the Kremlin. And in return, US intelligence reports indicate that Russia is providing Iran with targeting data for American warships. It's a geopolitical doom loop. The United States is financing the very war machine it is trying to defeat in Ukraine, just to keep the lights on in Europe and gas prices down in America. Meanwhile, the US brokered peace talks between Kiev and Moscow have been postponed indefinitely. The West's attention is entirely consumed by the Persian Gulf, and Vladimir Putin, sitting on a pile of unexpectedly expensive oil, has absolutely no financial incentive to negotiate a ceasefire in Ukraine anytime soon. In fact, Putin has brazenly offered to mediate the US-Iran conflict himself, posturing as a peacemaker while reaping the financial rewards of the chaos. Whether this was a stroke of pure luck or a calculated masterstroke of geopolitical engineering, the reality remains the same. The sanctions architecture that took 4 years to build is being quietly dismantled in a matter of weeks, not because anyone forgave Russia, but because the global economy simply cannot survive a two-front energy war. But what do you think? Do you think Russia was simply the accidental beneficiary of this Iran war, or did Moscow entirely help engineer this crisis to break the Western sanctions regime? Let me know your thoughts down in the comments below. And if you want to understand exactly how the global debt and energy crisis could trigger a collapse in the US credit markets, you need to check out our video on that right over here. That's all from me today, though. Thank you guys very much for watching, and I'll see you again soon. This is Nick, signing off.